Welcome. This week's addition to Chariot Financial's Reverse Mortgage Weekly, where we talk about reverse mortgage loans and we talk about what they are, what they're not, some of the ins, some of the outs. One of the things that I really like to focus on, those of you who know us and follow us, is that I really like to focus on education. I really believe that when people understand this product and talk to people who actually have a reverse mortgage, they really start to find out the benefits and understand why this is such a life-changing event for a lot of people. So, and that's what I was asked that today, actually. What's your opinion? What would you do if you were me? Well, when people ask me what's my opinion in regards to the reverse mortgage, of course, I'm drinking the Kool-Aid. I'm 100% in. The second I am of age to get a reverse mortgage, I'm going to go out there and get one because I know it's part of my financial planning tool. I've also seen how it's worked in my clients' lives. So whenever somebody asks me, "Hey, what's your opinion? Should I get a reverse mortgage?" You don't want my opinion. I'm just gonna tell you the things that I know have been true, but where I think people will really understand this program and really have an idea as to how this is working in people's lives is to ask somebody who has one. That is the real key because then you can see exactly how it's working in their lives. People get a lot of different information from this about this program, and a lot of it just isn't very good. Some of it is completely untrue, and there's a lot of fear based on some of that information. And I've heard folks, financial gurus giving advice about this program, and the advice is just not very accurate. So here I am dispelling all the mystery about the program and giving you the facts, the good, the bad, and the ugly. Well, once again, thanks for joining me. My name is Zach Smith. I own Chariot Financial. I've been in the mortgage and real estate industry for 20 years. I started off, let's see here. It's okay. There we go. Okay. I got to get my technology working here. So, I've worked for a lot of the big banks. I worked for Chase Bank for a long time. I worked for Pulte Homes and then Pulte Mortgage for a long time. And also, most recently, Fairway Mortgage, big outfit. That's where I learned a lot about the reverse mortgage program. I just taught a class yesterday. I am certified to teach classes here in Colorado for the state for real estate agents for their CE credits. And, it's just been such a wonderful program, not only for clients who are looking to get some relief in retirement, but also for real estate agents who are, a good portion of our class was talking about folks who think they're just stuck, that there's not a way for them to basically move out of their current home into another home that they desire because they feel like they don't qualify for anything because of their income. Well, keep in mind with the reverse mortgage, the risk assessment is completely different than what you would see on a forward mortgage. On a forward mortgage, you start off the process of getting that, and the risk assessment is because there's a monthly payment involved, a required monthly payment. First thing the bank asks you, okay, you want to borrow some money? Great. We're happy to help you. How are you going to pay us back? So they start looking at your income. They start looking at your assets. They start looking at your credit, all of those things to determine what kind of borrower is this person? What is our risk? If we lend this money out, what's the risk of us not getting paid? Now, with a reverse mortgage, completely different risk assessment because they're not looking at your income, assets, and credit. Yes, there is some light requirements in regards to income, but a lot of times folks who are on Social Security can qualify for these programs because really what we're looking is that you have some residual income and that you're able to cover all of your living expenses, your HOA, your maintenance on the property, taxes, and insurance. That's really the main thing that we're looking at. We're not looking at all of your debt, just those things. That and your age and the equity in the property. So anyways, let's go ahead and get started here. Again, my name's Zach Smith. I own Chariot Financial. We've been doing this for a long time. And that's another thing that I touched on in our class yesterday was that, with the real estate market, especially in the mortgage world, things have gotten a little tight because mortgage applications have gone down and the interest rates have increased. So a lot of these mortgage folks are out there thinking, oh my gosh, what am I going to do? I'll just start doing reverse mortgages. So there is a lot of people in the industry, and that's not necessarily a bad thing. I think it's great that more people are promoting this program and getting it out there. But one thing to keep in mind is that this is not a program that you can just jump into and know. And I when I first started doing these 8 years ago, I mean, I know so much more now over that 8 years than I did when I first started. So, anyway, so this is what we're going to be going over in this short presentation. Who are typical clients that we see for the reverse mortgage? What a reverse mortgage is, what a reverse mortgage is not, and why people are choosing the reverse mortgage, and also how do they work in simple terms. So, who are typical clients that we're seeing for the reverse mortgage? So, basically, older adults that are looking for an increase in cash flow. So, that becomes a big deal in retirement, mainly because we're not wanting to. We're either not wanting to work into our 60s or 70s, or we're on fixed incomes. We can't work. We're basically on Social Security, pensions, things like that. But we're not able to, in most cases, make the same amount that we have in the past. So a lot of times, if we're on fixed incomes, then tight cash flow becomes an issue. So that's the number one client that we see. Number two are basically older adults that are in need of relief from higher monthly payments, debts like a mortgage loan, credit card debt, car payments, medical bills. That's still the number one reason why people file for bankruptcy in our, first world country here is medical bills. So when people are being just, crushed by this debt, some of these credit card payments, especially with the Fed raising those interest rates, I mean, we're pushing almost 30% on some of these. So when people are being crushed by that debt, the reverse mortgage is a great option to relieve some of that, either by paying that debt off or converting things like a mortgage into a payment optional program. That has just been a life-changing event for a lot of folks. And also, lastly, retirees that are looking to establish a safety net for unforeseen costs. There's a assumption out there that the reverse mortgage is a loan of last result or resort, that basically you get a reverse mortgage because you don't have any other options. It's actually the folks who are really using this and leveraging this for victory in their retirement are thinking the exact opposite. For instance, myself, I said I was a bad guy to go to for an opinion on should you get a reverse mortgage or not, because the second I'm eligible for a reverse mortgage, I am running down to the bank to get one. And it's basically just part of my whole financial plan. It's part of my whole overview and whole gestalt view of my financial planning and how I want to really try to pass on a little more net worth, not so much more equity to my heirs. So that's really the how people look at this when you do own your home free and clear, and you do have a large amount of assets in the bank. There's some really good tax benefits for the reverse mortgage that that people have been taking advantage of. One of the things that happens in retirement, if you do have a lot of assets, especially in IRAs that are not a Roth IRA where the taxes are paid up front, is you have to have mandatory withdrawals at a certain age. And once you have those mandatory withdrawals, let's say you have to take out 50,000. Well, if you take out 50,000, then you're going to be required to get a 1099 from the government saying, hey, you just took $50,000 out of your IRA. We want our cut. Where's our cut? So offsetting those costs and things like that have been a great way for people to really plan and look at the reverse mortgage product is more than just a mortgage product of last resort. So what is a reverse mortgage? So it's a mortgage loan, just like any other loan. It does have monthly payments, and that's one thing that is I don't think enough people talk about with the reverse mortgage is that there are monthly payments with the reverse mortgage. They're just optional. So a lot of folks, you talk about the reverse mortgage, and some people will say, "Oh, well, that's just a way you're going to go upside down on your house if you do that." Well, going upside down is definitely something that can happen, but it is a choice. Again, you can go upside down on a reverse mortgage, but it is a choice. If you want to make monthly payments on the reverse mortgage, just like any other loan, you can, but it leaves it completely up to that person. For instance, let's say the second I turn 62 and I get a reverse mortgage, and God willing, I live to 100. Let's say at 62, I take out a reverse mortgage and I owe, say, 300,000 on my house. So I take that reverse mortgage out. If I live to 100, with the grace of God, then I would have had that mortgage for what, 38 years? So I more than likely will be going upside down. Now, of course, that all depends on how the real estate market is going. All of the research right now is saying that the real estate market has got a lot of pent up demand. Freddie Mac just did a study, and they think that 50 million millennials are going to enter the real estate market, the home buying market, in the next 10 years. That means that the demand is just overwhelming right now for housing. So a lot of people, I have some clients that are saying, I'm on the fence about buying. I think I'm just going to wait. I'm going to wait for the interest rates to go down. Well, this is my prediction. I could be wrong, but once the interest rates go down, the property values are going to skyrocket again. It's all about supply and demand. I mean, every business, that's business 101, supply and demand. If there's a low supply, then there's a high demand and prices are going to go up. So if the rates drop, the properties, in my opinion, are probably just going to increase again, which, you're buying the same property for $50,000, $60,000 more than you could a year ago. But now, you're in a position where you got a little bit lower interest rate, but you're paying $60,000 more. So are you really winning in the end? That's why, when I speak with folks, a lot of times we talk about, you date the rate, you marry the mortgage, so if the rates go down, you can always refinance. I've digressed here. Let me get back to the topic. So monthly payments, they are optional. So you can pay this thing off if you want, if you get a reverse mortgage. So generally, with a line of credit, generally the reverse mortgage has a line of credit attached to it, a cash payout, or what they call a tenured payment that would be paid out over time, kind of like converting the house into an annuity where you get paid back each month. It's been my experience that most people feel like they think that is the way that these work, is just only the tenured payment that you get money back. That is a way that we can set it up, but 90% of my clients choose not to do that. Most of my clients choose the line of credit just because of the flexibility. The line of credit is great because if you need cash, you can get it. But if you don't need the cash, you can just let it sit there. And the other great thing about the line of credit is you get access to more cash as time goes on. It's almost like having another savings account in the sense that you start off at, let's say you start off a line of credit 20,000. Well, in 5 years, it may go to 50,000 or 60,000. Now, those are all going to be tied to current interest rates. So what are people getting in interest rates right now? 7 to 8%. So a lot of these folks who have these line of credits on their reverse mortgage are getting almost 7 to 8% growth in regards to that line of credit. So let's continue here. So what a reverse mortgage is not. Reverse mortgage is not a government takeover of your home. And just, I'm putting out some figures out there. I'm not offering any of this to anybody or anything. These are just for examples. I'm not saying that this is where the interest rates are at or whatever. These are just examples so that the class slides will make more sense and we can paint a more accurate picture for people. So it's not a way to make you upside down on your home. either. You can go upside down on your home with a reverse mortgage, but it's not, again, that is somewhat of a choice because you have monthly payments each month. And if you choose not to make those, which is completely your choice, then you could go upside down. And, a lot of my clients, they take a look at how our current financial system is set up. What's the number one loan that people get right now? The number one loan that people get when they're purchasing or when they're basically purchasing or refinancing is they get a 30-year fixed loan. Well, in a 30-year fixed loan, those terms are really stacked against the consumer. Those programs were originated back in the old Depression days. The banks had just started getting rolling, kind of like in 2008, when a lot of banks got swallowed up by the big fish swallowed the little fish. Well, a lot of those programs came out of an era of that type. And this is the thing about a 30-year fixed loan, is that when you're paying on a 30-year fixed loan, 50% of the interest, 50% of the interest is being paid in the first 10 years. So what does that mean? That means that all the interest that you're paying to the bank is front loaded at the beginning. I'll give you an example. One of my clients closed a loan for $605,000 last year at the low rates back then. Now it's a low rate of 6.125%, 6.125%. Principal and interest payment was $3,600. Guess how much was actually going to pay off the loan each month? $600. So the terms that the bank has set up, and this is with every 30-year fixed loan, rate versus the term. Every 30-year fixed loan is set up this way. So it's 6.125%, $3,600 payment. Basically, we agree and we say, okay, thanks for lending me, the 600,000. Our agreement is I'm going to pay you on an amortized schedule over 30 years. Well, how that works for those first few payments is not for the first 5-10 years. You're really not paying that much principal. So with the first payment, you're paying $3,000 in interest, and only $600 is going to pay off that $600,000 note. And we accept this as just, oh, this is a great deal. Even the folks that got a 3% interest rate or 4%, oh, this is great. Well, it's the amortization is still stacked against the consumer. So anyways, a lot of them, some of my clients will take a look at that and say, you know what? Instead of taking my hard-earned retirement, my hard-earned income each month, and basically handing a large portion of it over to the bank in interest, I'm going to go ahead and take that payment and just put it in my pocket. And then you can direct it. Then you can become more liquid. You can direct it and invest it in the way that you feel fit. And you're not putting yourself in a position where you're still paying interest. You're just not paying it out of pocket. So that, just to clarify, there's still a monthly payment. You're still getting paid interest, but at the current moment, you don't have to come out of pocket for that. So for instance, the example that I made earlier with myself, $300,000, paying it off at 62, having that loan for 48 years, there's a chance that I'll go upside down if I have that loan for 38 years. But there's also the fact that I haven't paid a mortgage in 38 years. So that $300,000, let's say I'm making a $2,000 a month payment for that. Well, what kind of investment vehicle could you find to put $2,000 in each month? And if you had that for 38 years, how much do you think you'd have in compounding interest? It's just an incredible thing to think about, and just a different way of thinking. So again, it's not a way to make you upside down in your home. You can go upside down, but it is really a choice at the end of the day. It's not a payment-free mortgage, and big group came out, they had their celebrity sponsors and all that stuff, and they got in trouble. The Federal Trade Commission said, hey, you can't say that. This is not something you can say that is payment-free mortgage. So there is a payment, but it's optional. So why are so many people choosing this program in retirement? This has become a wildly popular program with a lot of folks. So why? Where's the beef? Why are people choosing these? Well, in my opinion, I think it's pretty simple. liquidity is the number one reason most people are choosing these. And number two, people who are following the benefits of the long-term financial planning with this product, that's another reason why people are choosing these. So let's talk a little bit about liquidity. So, you know, home equity is great to have, but the unfortunate thing about home equity is it's not liquid. So, for instance, it's a lot like having a glass coffee table right in the middle of your living room full of cash that you can't get to. So, you're sitting there, you're watching your favorite team, on the couch, your favorite show, and oh gosh, look at all that equity in that glass coffee table. Isn't that great? It's great, but it's really not doing anything for you. It's not going to work for you. And there's all kinds of classes, and you can talk to any financial planner about how wealthy people stay wealthy. Well, wealthy people make money off of their money. Well, if your money is all locked up in that coffee table, you can't put it to work. It's just sitting there. So, for instance, you have folks who are, just really cash poor right now. They have $500,000 equity in their home, and it's really not doing anything for them in retirement. And there's a whole, we'll probably touch on this a little later in the webinar, but a lot of the financial planners out there who are just ignoring the reverse mortgage and ignoring people's home equity in retirement, I really do think that they're making a mistake. I really believe that people should have the full view of every product available and let them kind of pick and choose what they think is going to be best for them. And we'll go into more detail about that in just a little bit. So, the thing is, we can't take a picture of our house and go to the grocery store and pay for our groceries. So equity is great to have, and a lot of older adults have equity in their home right now. But the problem is it doesn't do any good because it's liquid; it's locked up in the property. So, why does this matter in retirement? Well, most retirees are on a fixed incomes and have limited cash flow. Again, a lot of my clients don't want to work into their 60s and 70s, or they're on Social Security or pensions, things of that nature. And one of the things again is unforeseen medical expenses can liquidate retirement assets prematurely. And think of all of your finances as buckets, and if you have your income bucket, you're getting very little from that usually in retirement unless you have a great pension program, things like that. Or you have your life savings, your nest egg. Your nest egg becomes vitally important in retirement because we don't know how long we're going to need it. We could live to 70, we could live to 100, we don't know. But the difference between 70 and 100 is 30 years. So to prepare and to make sure that you don't run out of assets prematurely, your nest egg becomes vitally important in retirement. Wade Pfau is a prolific writer of retirement and the reverse mortgage program, and he makes the analogy of a mountaintop. When you're climbing the mountain, that's your way working yourself up to retirement. Well, when you reach the top, you are retired. Yay, hooray. But what every mountaineer knows, everybody who spends time in the high country, what they know is the most dangerous time is coming down. So once you're in retirement, you have to be very careful about the steps that you make and the decisions that you make, because if you make a wrong decision, you can fall much faster. That's why our nest egg becomes vitally important in retirement. And, if it was up to me, my clients would never have to touch their retirement at all. They would pass that on to their future generations. And that's really the whole concept behind the reverse mortgage program, is to pass on a higher net worth, not so much more equity. Sometimes you can do both. So the reverse mortgage really solves the problem of liquidity in retirement. It basically, that glass coffee table sitting in the middle of your living room full of cash, basically just installs a little drawer. If you need it, you take it out. If you don't need it, then you keep it in there. That's basically how the line of credit would work. Or the reverse mortgage establishes a line of credit. That's how that would work. A cash payout, so a guy'd show up with a suitcase full of cash for you at closing, or convert the existing mortgage payment into an optional reverse mortgage payment. It's a lot like my client that I worked with a few years ago, and several clients have been in this situation. Couldn't retire from her job because she had a big mortgage payment. She hated her job. She hated going there. She worked for the grocery stores. During the pandemic, she was considered an essential employee, so she had to go to work every day. And she didn't want to stop going to work or retire because she had to make her mortgage payment. And, she didn't want to sell her house or anything. That's her home. That's where she's lived for several years. Her and her sister lived there. And she took care of her sister. So losing the house wasn't an option. So she put herself together every day to go to work, terrified during those days. And the solution was right in front of her the whole time. She had plenty of equity in her home. We converted her current mortgage into a payment optional reverse mortgage. She's choosing not to make the payment. And what kind of relief does she have now, knowing that not only is she retired, but she can live the rest of her life in her home without ever having to make a mortgage payment? It's one of the most life-changing programs that I've ever had the privilege of originating in my 20 years of being in the business. So the reverse mortgage is a financial planning tool. So some Americans are living longer, which creates a lot of concern about running out of retirement assets prematurely. So, there's been a lot of research done about this, and it's not, my research, the research is probably a little bit above my pay grade, I have to admit. But, let's see, Sean Pfeiffer and John Salter of Texas Tech University published an article about the academic acceptance of the reverse mortgage product as it pertains to the survivability rate of one's assets when using home equity in a retirement plan. And here are the graphs. Basically, you can see all of these graphs represent, the Saxon Sachs study, the Texas Tech study, and basically every single one points to if you use your home equity as part of your retirement plan, you are much more likely not to exhaust your retirement or your nest egg in the long term. So utilizing the home equity is an incredible tool that I don't think enough people are using right now. So there's different types of reverse mortgage programs. You hear the term HECM a lot. Well, what the heck is a HECM? Well, a HECM is just FHA's version of the home equity conversion loan, is what they call it. It's got safety features for the homeowner, not such as a non-recourse feature. So you're never going to owe more on the property than what it's worth. If the bank goes under, if it fails, they have safety features for that as well. And it's also got increased access to funds with the line of credit over time. So you do get, again, that line of credit is almost like having another savings account, and it grows by the current interest rates. So those are what? It's 7-8% right now. Well, we know this fella. This is our buddy Tom Selleck, and he hit the nail on the head when he said the reverse mortgage loan is just like any other loan. The only difference is how you pay it back. So why is it called a reverse mortgage? Well, the reverse mortgage is still a mortgage. It has a monthly payment. However, this payment is optional. I think people have called it the reverse mortgage because you can convert the mortgage or the home equity into paying you each month. So it's going the other way. And it also could be considered a reverse mortgage because the amortization is negative. So you're still getting stuck in the amortization schedule that every bank lends money. Unless you're in a simple interest loan, you're going to be stuck with amortization. But in retirement, not having to make that monthly payment each month out of pocket has become extremely valuable for people. Yes, it is a trade-off. You're giving up some of your equity so that you don't have to make that monthly payment. But again, if you want to know how this is working out for folks, just talk to people who have one, and they can tell you not having to have that burden or crack that nut every single month and make that monthly payment has made a world of difference for them. So taxes and insurance generally will need to be paid separately. Two biggest myths that I hear about the reverse mortgage that couldn't be further from the truth: that you'll be upside down on your house within a few years. You can go upside down on your house with a reverse mortgage, but it's a very slow process. And a lot of it's going to be dependent on interest rates in the future and home values in the future. I mean, right now, if Freddie Mac is right, Freddie Mac's pretty quasi-governmental agency. say what you will about Freddie Mac and Fannie Mae, but they are the ones buying all the mortgages. They hold all the cards. So their research has said that 50 million millennials are going into the housing market, and that's basically going to keep the demand high for several years. There's not a coincidence that BlackRock and Vanguard and all these big hedge groups are buying up swaths of properties in the suburban areas right now. In my opinion, I think they want to control the housing market. They want to control the rental market. So that's one thing to keep in mind, that home values will probably increase. But then again, that's just my crystal ball prediction. And secondly, the biggest myth is that you no longer own title to the home. That couldn't be further from the truth. It's just like any other loan. You have a lien attached to your property. So again, 3 ways to structure the reverse mortgage. You can get a line of credit that grows over time, a cash payment, or a tenured payment, basically paying you back each month. So how is the qualified amount determined? This is probably one of the most different features for this loan, aside from the risk assessment, not using your income, assets, and credit. They use your age. So your age plays a large role. For the HECM program, the minimum age requirement is 62. But they're basically saying that they use an actuary table. So someone who is 62 can borrow less than someone who is 82, because they're basically counting on the person who's 82 being in the house less time. So they give them access to more equity. Well, that's all I got for you today. We're trying to keep these right at 30 minutes so you can get on with your day. If you have any questions for me, you can always reach out to me at chariotreverse.com. You can also go to happyhousetoday.com. But if you have any questions for me, don't hesitate to visit those sites. You can contact me several ways, schedule time with me, or if you just want to kick the tires and get a little more information, we can do that as well. So I hope you have a great rest of your day, and thanks so much for joining us today. Thanks a lot.